Welcome back. You're still tuned in to Midcap Radar. Well, the markets are under pressure in the last couple of trading sessions, but when the markets were doing well, one segment or one sector that did not contribute here was the chemical space. Q3 and Q4, they have been very weak for the sector as a whole. So let's put spotlight on the chemical space. There have been a lot of talks of destocking, pricing pressure, but what now? Prabhudas Leeladhar in a recent note said that China continues to dominate despite shutdown of 40% chemical capacity in 2017 and its market share in global sales rose to 44% in calendar year 2022. To discuss the China production impact on Indian chemicals industry and a lot more, we have Swarnendu Bhushan, the co-head of research at Prabhudas Leeladhar. Swarnendu, good afternoon. Thank you so much for joining us. Well, it's an interesting note that you've put out and that talks about what's happening in the global chemical space. China continues to dominate production, as you said. But is it also converting into higher demand? Can you give us a sense of where China is able to sell these chemicals? Is demand good in China as a market, or is it dumping in the global markets?
Hi, good afternoon. So, as you rightly said that China has been producing a lot, but Chinese demand we have not seen recovering to that extent. And as a result of that, as we have highlighted in our note also, if you look at import to Europe, for example, China earlier used to command 14% of market share in imports of chemicals to Europe. And now we are seeing that they have almost 25% market share in import of chemicals in Europe. So they are basically dumping chemicals globally. Their market share, as we have highlighted, has risen from 40% odd in CY17 to almost 44% as of now. So they are gaining market share. They are dumping a lot of materials, as a result of which we are seeing that realizations are also going down. And as a result of which we have seen that post FY13, most of the Indian chemical companies have reported lower profitabilities.
So in light of this, Swarnendu, since you mentioned that realizations are going down, talk about the pricing scenario as well. Now that China is dumping in the global markets, it's possibly unlikely that pricing would see any form of recovery. But what is the situation currently? Do you see any chances of a price recovery? And is that happening in the market as of now?
So prices are recovering a little bit along with the rise in crude oil prices, because crude oil prices are the basic starting material for a lot of organic chemicals. So we are seeing a slight recovery in the prices, but the margins are still yet to recover. So the profitability from that perspective might not really increase as a result of the rise in realization for these chemicals.
Okay, so there is pricing recovery, but that is not something that can convert into higher margins at the current state. So, Aninu, the other thing that you mentioned, one is the China factor. The other thing that you mentioned is EU27. That is the other joker in the pack, or that is something that we'll be watching out for closely. How is the European region contributing to whatever is happening in the chemicals industry right now? Are we seeing a recovery in demand in Europe especially?
So far, we have not seen any recovery in European demand. And what is also happening is that since we saw a very high surge in natural gas prices post Ukrainian-Russian strife, so as a result of that, and because of lower demand from Europe, European utilization levels have fallen dramatically. So if you look at CY23, the second half of that, you would see that European chemical industry would have operated at below 75% odd, which is the level at which they operated during COVID. And post the global meltdown of 2008-2009, we have never seen these kind of low utilizations in Europe. Now, tomorrow, if say European demand also recovers, then what will happen is that along with the demand, the utilization levels of the European companies will rise, because now the gas prices have normalized. So gas prices are now at $8-9 per MMBTU, at which most of the chemical companies in Europe will be firing back to their full capacity. So there is a surge of 8 to 9% in utilizations in Europe that could come hitting Indian chemical companies, wherever Indian chemical companies are basically competing with the European manufacturers. So that is the thing that we have highlighted in our report as well.
Right. You know, Swarnendu, I was reading your report. You have a cautious call on the sector, and most of the stocks where you have a reduced rating or a hold or a sell recommendation, but the one stock you're positive on is Navin Fluorine. Why is that so? The stock is almost down 30% over the last 12 months. What is keeping you positive on Navin Fluorine while remaining cautious on the sector as a whole and compared to its peers as well?
So the DNA of the company, we believe, is a little bit different from other companies. So they normally go into partnerships where to a large extent the volumes are guaranteed. So if the market goes down, definitely they will also have impact, but that impact will be not commensurate to what the other companies might be feeling. And fluorination is a very interesting place. We are seeing that a lot of new applications of fluorination are emerging, not only in pharma and agrochemicals, but also in polymers. So that keeps us positive on the stock despite the fall.
And versus SRF, do you think the other segments of SRF where it caters to, that is something which would put pressure? Generally, what's your idea on that one?
So SRF is another good company, but from valuation perspective, that is where we are not very comfortable with the stock. So even if I give 8 times multiple to your packaging and technical textiles, then the implied EV by EBITDA for your whole chemicals space would be much higher than what would be attributed to the company. So that is where we have the discomfort. Otherwise, SRF definitely is a very good company to stay invested in.
Swarnendu, you highlighted multiple issues in your first couple of answers with China dumping and European utilizations being at historic lows. Do you see a recovery anytime soon in some of these issues that you are highlighting? And if so, when is the question?
So in bits and pockets, we have seen recovery. So for example, rig counts, if you see in the US, stays very strong. So last week, they had reported a decline, but then last week they compensated for the decline that had happened. So from that perspective, ATBS, for example, would have good utilizations. So from what we understand, Vinati would be having, say, 85% utilization at ATBS plant. So in bits and pieces, you will see that recovery is coming. But largely, if you look at the recently concluded results of most of the global companies, they have been very cautious about the demand panning out in the whole of CY24. So most of those companies would be guiding at, say, 2 to 2.5% volume growth in the whole of the year, which basically means that there is no recovery yet to be seen in the whole of CY24.
It's quite chemical specific as well, right, Swarnendu, because every chemical has a different usage, different geography. But last question before we let you go, is the capex plan of any company getting impacted because of this? Are you seeing any pullbacks there?
So already they have not cancelled, but we have seen a lot of Indian chemical companies sort of realigning their capex programs. So that we have seen across most of the companies in the Indian chemical space.
All right, Swarnendu, thanks a lot for joining in and sharing your views on the chemical space. That was Prabhudas Leeladhar. They're cautious on the chemical sector as a whole, but positive on Navin Fluorine. With that, we'll slip into a short break here on Midcap Radar. More on the markets and specific stocks on the other side. Stay tuned. We'll be right back.